Welcome, everybody. Happy Thursday to you. Minds of Markets live stream. No, I am not, unfortunately, live on the floor with these guys today, though I was with a bunch of them yesterday at a SIBO golf outing. But there's a lot going on here. First and foremost, I would appreciate if those of you who are here, if you could give us a quick shout out in the chat just to let us know that you can hear and see everything okay. That would be very helpful for us because I am on a remote setup today. Like I said, I am not on the floor. So that would be great. Maybe Mike, you can do that, and anybody else that is here, that would be awesome. All right, all good. Yes, thank you. All right. Perfect. All right, guys, what is going on in the markets here? I mean, obviously everybody likes this move today, right? We're up 93 handles, we call it 93 points in the S&Ps right now. Dow is up almost just over 500 points. Actually, let's go to our charts here. The Nas is up almost 400 points. Here is the SPY, so I'll put that up on the screen here. We all like to see the green, right? But these moves that we are seeing in the marketplace, guys, this is not really healthy for the market. It really isn't. We don't want to see these swings, 100-point swings in the market on a daily basis. In fact, yesterday we had, 135-point swing from the very top down to the bottom yesterday. Today, another 100 points. Yes, it's certainly on the upside. Now, I certainly, I kind of have an issue with today's move. Not an issue that I'm not happy about it. Yeah, we all like to see the green, right? But the fact that the market could move so quickly and so dramatically on one economic data point, and not even one that's the big jobs number, not CPI, not PCE, not a Fed move. We're talking about the weekly jobless claims number that came out this morning. That's what the market moved on. And if the market is going to continue to be this volatile based on every single data point that comes out, especially between now and when the Fed meets next month, that's actually going to be an issue, I think. That kind of volatility is not good. It's not healthy for the marketplace in terms of, re-grasping, let's say, a move higher. It really is not. The market doesn't like uncertainty. And even when that uncertainty is to the upside, the market doesn't like that. And that could have been what we saw yesterday with the massive rally and then the sell-off at the end of the day. But that is, what we're seeing today is indicative of a nervous market. It is, indicative of even the algos out there, which are computer driven. It's indicative of a lot of uncertainty. And should we have uncertainty? Absolutely, right? I mean, with everything going on in our political landscape and interest rates in the Fed, and then you throw in what is going on maybe with Israel and Lebanon and that whole situation, and Ukraine and Russia is still happening, and we've got the whole what seems to be like everybody forgot about what just happened Sunday, Monday, Tuesday, right? With the yen and the carry trade. What happened to that? I don't even hear that anymore. And that was just 48 hours ago. So there is a lot going on in the marketplace. And I think it substantiates some of the volatility that we're seeing right now. I think it does substantiate seeing the VIX trading right now around 25, 26. Doesn't really substantiate the spike up 50, 60 that we saw the other day. But it does substantiate this. And while we're talking about the VIX, how many of you not just understand what the VIX is and how it's calculated and what it's representative of, but how many of you understand what that number really means? So you should all see that I circled on the screen where the current VIX, the spot VIX is trading, and we'll just say it's trading 26. Okay, we'll round it off. How many of you actually understand what that means? Okay, because it's really, okay, William, not at all. That's a great, honest answer, and I'm going to explain it. Okay, the VIX is a measurement of S&P 500 options 30 days out. Okay, it's the implied volatility of 30-day options in the S&P. Okay, now, the VIX is a measurement. We've seen it, for 3-4 months leading up to this, big period of volatility. We saw the VIX really depressed down at 11, 12, 13. Saw the VIX explode up to 60. Now it's sitting in the mid-20s, probably still a little bit elevated. But here's what VIX means. And can everybody see my yellow on the screen? Okay, good. So here is the benchmark. If you see a VIX at a level of 16, okay, a VIX 16 is equivalent to a daily move in the S&P 500 of 1%. Okay, that is the equivalent. And I'll go through the math on that another time. I don't have to bore you with it right now because it is a mathematical calculation based on the number of trading days in the year and the square root of that. So we'll go into that another time. But if you see the VIX trading 16, which is not far off from its historical average, that is representative of a 1% daily move in the S&Ps. If you see a VIX of 32, that is representative of a 2% daily move in the S&Ps. Okay? Well, over the last, couple days, and couple days can't, we can't make a great case study on just a couple days. But where have we seen the markets move over the last week or so? We're seeing these 2% moves a day, right? Maybe 1.5%, 2% daily moves. Well, if that is going to sustain, then we should be seeing a VIX right around here, because just using simple math, if we use that VIX of 16 and a VIX of 32, and we look at the midpoint of that, which is 24, and we know that 16 is a 1% move, 32 is a 2% move. Well, 24 is representative of a daily approximate 1.5% move. We're seeing that. So if we continue to see these sort of moves in the markets, then this VIX at 25, 26, 27, or whatever it might be is justified. Okay? There is an unbelievably accurate correlation between daily percentage moves in the S&P and the VIX. So, we don't really see elevated VIX levels remain that way for very long. When I say elevated, typically people will say if VIX has a 3 handle, meaning 30 or higher, that's elevated. I'm talking, 35 or higher, 35, 40, 50. Whatever it may be. We don't see that happen very long because that correlation to the S&Ps is so tight and so accurate. If you were seeing a VIX of 35 but the S&Ps were moving only 1% a day, okay, something would have to change dramatically very, very quickly. One of two things would have to happen. Either the VIX is going to come crashing down, or the market is going to start moving dramatically, much more volatile. Okay? And vice versa. When VIX was really complacent, really, I don't want to say depressed, but really at a low level, around 13 or 14. If we were seeing the S&Ps move 1.5% a day at that point, something's got to correct itself really, really quickly. Either the VIX has to really move higher quickly, or the market has to start calming down. We don't see that aberration. We don't see that kind of ratio, if you will, or correlation out of line for very long. The market corrects itself really, really quickly. Does that make sense to you? And again, I don't want to go into a math case study or algebra or anything like that here, guys, because we're here to talk about the markets right now. But there is, in mathematical and statistical terms, something relevant about the power of 16. Okay, so just remember out of this, guys, if you're going to take anything away from this, just remember a VIX of 16, 1% daily move in the S&Ps. Okay, so that'll be a barometer, that'll be a benchmark, that'll be a measurement for you. Now, let's talk about what's happening in the markets here with this really, really powerful rally today. Though, listen, we saw this yesterday as well. And then the last, hour and a half, 2 hours of the day, we saw what? We saw the market really sell off hard. Anybody know why that happened yesterday? And yes, there's obviously a lot of things going on at once, but does anybody know what drove that yesterday? Okay, there was midday, I think it was at 1 o'clock, there was a treasury auction. Okay, which those of you that actually read or follow our weekly week ahead emails that go out on Sundays, giving us, there you go, Deborah, giving us a look at, what just happened and then what to look for in the coming week. One of the things I highlight on the economic calendar every week are treasury auctions. Not all of them, but I highlight the big ones, whether there's a 10-year auction, a 30-year auction, sometimes a 3 and 6 month auction. Okay, well, yesterday there was an auction, which means government has, government securities, treasuries to sell. And every time this happens, and you can see this on CNBC, the other networks as well, and Rick Santelli, as much as I don't like him, he is real spot on with this analysis. He talks about something called bid to cover. Okay? Bid to cover is the real important metric during a treasury auction, which tells us how much did people want to buy these bonds, these treasuries. Okay? And if there's they're oversubscribed, right? Like, people are clamoring to buy the government treasuries. What does that tell us? And remember, I'm going to give you just a little hint here. The price of bonds, the price of treasuries is inverted to yields, to interest rates. Okay? So if the government is selling debt, right? They're selling their bonds, T-bills, treasuries, whatever it is. And there is a very, very, very large bid to cover, meaning, boy, the institutions, the banks, whomever it is buying these things up, they can't wait to get these things. How does the market perceive that? What happens to interest rates? Anybody? Markets are pretty steady right now. What happens is, well, the more demand there is for something, right? The more demand there is for anything, prices are going up. Okay? Exactly. Deborah, you got it. Scott, you got it. Very nice. The more demand, prices are going up in this case, and rates are coming down. Okay? Because if you think of it, and it is not an easy concept to understand, guys. I get that. But if you think of it, if the government is going to pay you, right? You're making an investment and they're giving you an interest rate to pay you. Well, if everybody out there wants what I am selling, then I'm going to offer you a lower rate. I'm going to raise the price and I'm going to offer you a lower rate. Think of it that way. Okay? Because I know, again, it is a very difficult concept to understand that as prices of bonds go up, rates go down. Does that make sense to everybody? Right? It's simple supply and demand, just like everything else, everyone. It is simple supply and demand. The more demand there is for government securities, either the higher the price the government is going to sell them, or the lower the interest rate they're going to have to pay. Okay? Well, what happened yesterday was the bid to cover was awful. Or I shouldn't say awful. It was much lower than expected. There wasn't as big of demand for the government securities yesterday. So the opposite was happening. Okay? If the government can't sell what they have, or they're having trouble selling what they have, what do they have to do? They have to lower the price, offer higher interest rates. That's what spooked the market yesterday, because we've been in this environment over the last couple of weeks since we've been getting the softer economic data. We've been in this environment that have seen interest rates move down pretty dramatically. We've seen the 10-year interest rate, which was near 4.6% about a month ago, traded all the way down to 3.7 and change just a few days ago. Now it's hovering right back at 4%. But we've seen interest rates really coming down. Well, now all of a sudden yesterday, there was a very light demand for what the government was offering. That was taken very, very negatively by the marketplace. That rates had to start moving up yesterday. And if you look at any of the yield curves yesterday, you'll see rates that ticked up. So that was yesterday's story. Today's story, it's the jobs report. The weekly jobs report, not a monthly. Not a monthly. And this is my case in point here, that every one of these data points, which they are important, but maybe it's like a C, right? If I had to rate the importance of economic releases, obviously a Fed decision is going to be an A. CPI is going to be an A. PCE is going to be an A. Monthly jobs report is going to be an A. And then you get to some of the other reports, ISM manufacturing and retail sales data. Okay, maybe those are a B. They're important. They're not as important. Weekly jobs numbers is like a C. Okay? But this just tells you the nervousness in the markets right now. Okay? So I kind of took this discussion a little bit differently than I had initially thought I was going to, but while we were on the topic of, VIX and 1% and what does that mean to the markets, and then talking about these 100-point swings in the market, I really kind of wanted to detail to everybody what the cause and effect was over the last couple of days. Regardless, needless to say, we will keep seeing extended volatility in the marketplace. Maybe not a VIX at 25. In fact, I would bet that as we get a little deeper into the month and towards Labor Day, VIX probably comes down even more from here, and we'll probably see it back into the mid-teens level. At which point, if we do, to me, would be a massive, massive buy. Okay, because with the election coming up here, guys, anything can happen. Anything can happen. So, as I always tell everybody, whether it's here in the rooms, on TV, as I always tell everybody, as I learned literally my first trading day on the floor 30 some odd years ago, okay, you buy when you can and not when you have to. Meaning, you look at your technicals, you look at your charts, and if the VIX gets down to a level that's a buy area or volatility gets down to a level, you buy it. You buy it because when the you-know-what hits the fan or when something happens, not even a black swan event, but something happens and you start seeing that volatility spike and you're not protected, what do we see? It's like a self-fulfilling prophecy, everybody running after protection. That's, again, supply and demand. Everybody wants to buy upside VIX calls. Everybody wants to buy downside S&P puts. Everybody just wants to buy volatility across the board. Well, supply and demand. More buyers, less sellers, drives prices up, drives volatility up. Simple economics. The market runs on simple economics. Okay. Can't believe there's any interest to buy U.S. debt these days. Why not, Mel? If you can get 4 or 5%, where else are you going to get that in the world? Where else are you going to get that? It's not like, and now I'm going to go off topic here, and this is fine, because Mel, I appreciate you making the comment here, and it brings up another discussion. Who remembers hearing all across the media, the news, and the like from, basically 2020 till about, till the Fed started really raising rates last year? Who heard of the TINA trade? T-I-N-A. The TINA trade. Not Tina Turner, but the TINA trade. Who heard of that, but maybe doesn't really understand what that was? Because this is a perfect representation of exactly what we're talking about right now. TINA, TINA stands for there is no alternative. What does that mean? Well, when interest rates were 0, 0.5%, 1%, okay, why would people invest in those securities unless you were totally in panic mode and wanting to just have the safest place to park your money, right? So what did we see when interest rates were super low? 0, 0.5%, 1%. What did we see the market do? Right? There you go, Gary. There is no alternative. We saw the market rally, explode big time because the opportunity cost of investing in securities that were paying you, or government debt that was paying you next to nothing versus investing in the stock market, huge opportunity cost. So that was the TINA trade. But as rates went higher, as the Fed was raising and raising and raising, and rates went higher, and we got up to what, 5%? You get 5.5% on some T-bills just not so long ago. Well, now people that would put their money just in the stock market or something maybe a bit riskier, now they have an alternative. So, Mel, to your point, that's why I'm not so sure I agree with you. Why would anybody buy it? Government's not going to default. Okay? If you're still able to get 4%, 4.5%, whatever it may be, safely, you compare that to the rest of the world, this is where I want my money. That's for sure. John, today the option delta seemed out of whack. What do you mean by option delta? Specifically to one stock or to one position? Or what exactly are you referring to? And I see someone wants to look at IREN, which we will do here. Iris Energy, which I have never heard of in my life, but happy to take a look at. SPX option delta seemed out of whack. Do you have an example of that, John? I'm not really sure what was out of whack. Okay, whoever it was that wanted to look at IREN here, just from a very quick technical snapshot, you can see how the 200-day moving average here, this blue line, going back, over the last 6 months, 9 months, whatever it was really, really good support in this stock. Well, we just got back down there and are bouncing off of that. Again, I don't know anything about the fundamentals of this company whatsoever. I'm just looking at it from the technical side of things. There's a ton of option volume for this stock traded over the last couple of days and decidedly on the call side. So if I was going to take a position here, I would definitely take a bullish position. Okay, in the money call was a 9 delta. John, again, I'd have to see more of an example of exactly what you were talking about, because something like that doesn't make sense to me, and the market is too efficient and wouldn't let that happen. But if you have a specific, I'm happy to take a look at it. I'd love to see if that happened or, what it was. CELC and Snowflake. Uh-oh. Come on, don't do that. All right, there we go, Live Vol. Thank you. You know what? Instead of Live Vol... Okay, there we go. You just came back up here. Okay. CELC. Thinking of bringing in my Think or Swim charts instead here. That's going to help us out a lot better. Hopefully everybody can see that here. Okay, CELC. Again, when I look at this from just a technical perspective, we've got the 200-day moving average right there, which held as support. Going way back here, same thing. Now, I know it just broke down here, and I'd have to see, there obviously had to be some specific news about this, but it recovered pretty quickly back above the 200. I'd have to be bullish here. I would have to be bullish. Okay, John, right now, let's bring this up. Are you saying right now the 5280 call is 7 delta? I want to bring this up. Okay, here we are on Think or Swim. Awaiting data because there are so many options that need to populate here. John, when are you saying that was? Right now or early this morning? Yeah, data feed's not coming through. That's not good. Oh, there we go. Okay. John, when was that you're saying the 5280 was 8 delta, 9 delta, whatever it was? Because I am not seeing that. Right now, the 5280 that expires today, okay, the 5280 that expires today is right here, and it's showing a 77 delta. So I'm not sure what you're seeing. I see a 77 delta for those right now. So I'm not sure what platform you're looking at, John, but I'll tell you what I'd like to do. I'm going to post my email address in here. If you can take a screenshot and send that to me right now, I will be happy to take a look at that and respond back to you. Okay? I can't believe that's a half an hour already, guys. I feel like we literally just started. Okay? Yeah, take a screenshot of that, John, and send that to me so I can look at that, please. Okay? What platform are you using, by the way? Thank you, everybody, for being here. I mean, that literally, this is like the quickest half hour I've ever experienced. I will be back down on the trading floor, not just this background that I have right now, but I will be back down on the trading floor on Tuesday. You guys have my emails here. Okay, you have my email up on the board there. If there's anything that you would like me to discuss on this live stream, please email me. I'm open for any suggestions. I'm also open for any feedback, good, bad, or indifferent. Okay? So let me know. This is made for you guys to give you real market information about what's going on, not just the fluff and stuff that you see all over the place. All right? So thank you, everybody. Again, John, shoot me an email with that. I'll be happy to get back to you. Really appreciate everybody being here today. We'll see you on the next one, guys.